Imagine you are in the middle of a desert and are being compensated with water for your work. How to preserve your water will be the first issue you encounter. So what is the solution? In place of using your hands, use a glass. Well, the second problem would be, what if the water evaporates? You need a bottle with a cap to stop evaporation in order to fix this. The next challenge will be planning for long-term reserves. To solve this problem, you can buy more bottles and add more space to your store. Well, the problem is still present. Someday, you'll have to start drinking from those bottles when you're too weak to work. Your lifespan in the desert will depend on how many bottles you are able to gather during the course of your working life. Some people in the desert may have saved enough to drink in their old age, but not everyone is so fortunate. So, what is the best course of action? Just own a water well in the desert. All issues have been resolved. Water in this story represents money. Water in a glass that evaporates represents money in a bank. Water in a bottle is an asset that appreciates with inflation. They maintain their value over time. Some real-world examples are commodities like real estate, gold, and silver. Accumulated water in a bottle represents savings and assets. Losing the strength to work represents retirement. A well of water represents cash-flowing assets like dividend investments and rental income. So, what financial lesson can you take away from this story? If you save money, its current value will evaporate over time. Some assets can protect us from financial instability. Since you will need to sell your assets to meet your needs, acquiring assets alone may not be sufficient to ensure that you have enough money in retirement. The well with water shows assets with positive cash flow. These assets generate passive income, which means they generate money even as you sleep. How can you, therefore, make your own finances better? One of the best ways to improve your personal finances is to invest in assets that bring in money. The most typical include royalties, enterprises, and real estate rentals. The first thing you should do is safeguard your savings from external factors like monetary policies that may evaporate the value of your labor-intensive efforts. Have a look at this list of the best cash flow asset ideas to see if any make sense for your situation and if you should consider them for your portfolio. 1. Dividend stock. There are two types of dividend-paying stocks. The company's board of directors decides on the common stock dividends each quarter. Until the board makes a decision, you won't know the sum or even if there will be a dividend. Dividends on preferred shares are paid out on a more regular basis. They are preset fixed payments made over a certain time frame. Additionally, preferred owners receive dividends ahead of common stockholders. Always seek out stocks with a dividend yield between 2% and 6%. 2. Bonds. Bonds are loans made to the state or a corporation. Bonds provide you with fixed interest rates as a kind of income. As the bondholder, lender, you get a set amount of interest income every month. You get your initial investment back at the conclusion of the loan period. Government bonds, commonly referred to as treasuries, are quite reliable because the U.S. government is backing them. Nevertheless, the cost is very modest and the yield is modest. State, city, county, and other governmental bodies may issue municipal bonds as a kind of treasury security. Interest is exempt from federal and in many cases state and local taxes. Corporate bonds are riskier than government bonds since they are issued by businesses, both public and private. Consequently, they offer greater interest rates than government bonds, depending on the issuer's creditworthiness. 3. Real estate. Even though real estate can and does appreciate, it can also be a reliable source of cash flow. The income comes from the rent paid by residential, commercial, or industrial tenants, and sometimes from the mortgage interest on the buildings. People often use REITs and RELPs to invest in real estate without becoming landlords. Through real estate investment trusts, REITs, you can buy shares in a publicly traded company that gives you dividends like stocks. Both the size and the frequency of the payouts might fluctuate. REITs are regarded as ongoing long-term investments and make a variety of project investments. With a real estate limited partnership, RELP, you and other investors can pool your money to buy or develop real estate as a private venture. Although RELP provides great dividend payments each year, the bulk of its earnings come from distributions made when projects are finished and eventually sold. 4. Money market funds. Money market funds, MMFs, are a unique type of fixed income mutual fund that invests in low-risk, short-term debt securities that pay dividends like most other investments that bring in money. By following the net asset value, NAV, standard, MMFs try to keep the value of each share at $1. Any surplus is given away as dividends. Because the NAV standard says that fund managers have to give investors dividends on a regular basis, investors get a steady stream of income. 5. Certificate of deposit. Also, banks offer investments that bring in money and are popular with investors because they are low risk. Certificates of deposit, CDs, are among the most popular. Savings accounts known as certificates of deposit, CDs, have terms of 6 months to 5 years. The interest rate increases with the length of time that you must keep your funds in the CD. 6. Money market accounts. Another popular banking product is money market accounts, sometimes known as money market savings accounts. They have more restrictions and frequently need a bigger initial balance to get the greatest interest rates, but they offer higher interest than typical savings accounts. Money market accounts allow up to 6 withdrawals each month, including interest. 7. Annuities. Annuities are contracts sold by insurance companies that make regular payments to you for a set period of time or for life. You invest an initial sum, and then the money is repaid to you in periodic installments, a process known as annuitization. The payments typically consist of both principal and interest. The 3 main types of annuities are fixed, which pay a set interest rate; variable, whose interest rate fluctuates depending on the investments, usually mutual funds, you choose; indexed, which provide a return based on an index, such as the S&P 500. The risk depends on the underlying stability of the insurance company and the type of annuity. Fixed is the least risky option, while indexed is the most risky. Conclusion. Income investing is often associated with older, often retired investors. Common financial wisdom says that as people age, their portfolios should shift from growth to income. Nonetheless, all investors can and should include income producers in their portfolios, if only as a counterbalance to aggressive growth assets. In general, you will see a better rate of return the more risk you are willing to take, or the longer you are willing to let your money work. Still, the main goal of income investing is to make money while taking on a level of risk that you can handle. The stable base of your portfolio should be made up of securities such as income-producing stocks, bonds, and other investments. By investing in income-oriented exchange-traded funds, ETFs, and mutual funds, you can always further diversify your risk. The benefit of passive income is that it allows you to receive money from other sources, even if your primary source of income is another job. Use it to live more comfortably or increase your wealth. Either way, having passive income helps. Good luck with setting up cash flow assets.